This is Ashleigh.clapper with the 904 Home Guide team in eXp Realty. We're over here at Movement Mortgage in Jacksonville Beach with Jamie Holmes. He is with Movement Mortgage, as I mentioned, and is going to be going over the start to finish of buying a house with the pre-approval all the way to a year or so after owning a home. So Jamie, tell us a little bit about yourself.
Thank you for having me. Jamie Holmes with Movement Mortgage. Been doing mortgages for about 9 years. Kind of entered the industry in a strange time in 2011 when most people were not avoiding buying a home. Real estate was a little bit different place. So at that time, we're kind of just helping do refinances. It's a great way to kind of get your feet wet in the industry and be able to deal with sometimes angry clients on the phone.
That's always fun.
Yeah, absolutely. So it's a good training ground, and now, basically my main book of business is working with realtors like yourselves and trying to earn opportunities to work with their buyers.
Awesome. So no change of mortgage lending anytime soon?
No, I mean, listen, this industry, it's always changing pace, but I kind of have the freedom to make my own schedules, which helps me with my family, and I get to choose who I get to work with for realtors, which is the best part.
Yeah, absolutely. Just like you, we get to choose, and I'm so happy that we choose to work with you, Jamie. You've done an excellent job with all of our clients, and I can't say enough and rave about you anytime I meet a new client, so I really appreciate it.
I appreciate those kind words.
Hey, absolutely. So first thing we're going to start with today is pre-approvals. Everything starts with that pre-approval,
right.
And why is it so important that you start with there, by the starting line?
So I like to say we want to start with a solid foundation. So how do we get there? And it's really about taking the time to take an application with a loan officer like myself. So we have two little paths we can go down. We can do a pre-qualification. That basically means that you've spoken to a loan officer on the phone, they've reviewed your information, pulled your credit, and you're telling them how much money they make, and then they kind of tell you, great, your credit scores are X, and you can be approved up to a certain loan amount.
Okay.
I want to take it a little bit a step further with a pre-approval, meaning yes, I'm going to take your application either over the phone or through a secure online portal, but then I want to collect the documents. I want to see your pay stubs. I want to see the bank statements. I want to verify all the information that you told me is 100% accurate. So when I issue a pre-approval letter, that means that I've reviewed everything and I know that you're good to go to buy this house.
Awesome, and that's one reason why we use you is because we like to make it the smoothest process when buying a home. So if you have all that information, we don't have any hiccups when we start to put in offers and see if everything actually is going to be pre-approved. So that is an awesome starting point. And as you mentioned, it's important because that's where you need to find out how much you can get approved for to buy a home. So we don't want you to get out there and looking at a home and wasting like our time, your time,
sure.
And even the buyer's time, because if you go look at a $300,000 home, but you say, hey, we can only get $280, now you've fallen in love with this home that you can't purchase. So
yeah, nothing worse than being emotionally attached to a property than to have your dreams crushed.
Yeah. Exactly.
At least, get your dreams crushed in the beginning. Let's just figure out what you can actually do before you get in that car, before your significant other or wife or whomever gets super excited, wants you to buy this house, and then you find out you can't do it. Let's just get the hard work done up front to make everything much smoother down the road.
Yeah, and making sure, even if you're buying a home 6 months from now, we had talked about this before, that it's very important. You have the 90-day period, I think you mentioned 90 to 100 days when you're pulling the credit for that pre-approval. So if you're not looking right now, still find that baseline so that the agent that you are working with is able to figure out the price and the location that you can purchase in, and then maybe you find that home sooner than 6 months, and you can jump on it then.
I want to find out the hurdles up front.
Yeah.
Right. When clients say listen, we're not going to move for another 3 months, so we'll probably wait until that time. Well, what if we find out there's an issue with your credit right now? What if there's a collection that pops up or something that's not reporting correctly?
Yeah.
We can get that fixed. Now we have time to do that. It's way harder once you want to make an offer. Then I say well, hang on a second, we got X, Y, and Z to take care of, and everybody gets really upset. Let's just go out again. Let's get all that done up front. So you don't have to worry about it down the road.
And this is one thing, again, I wasn't going to talk about today, but just a quick note on credit scores. Everybody uses Credit Karma now. I personally do it on my phone.
Yeah.
So people get pretty angry with me when, after they've spoken with you or somebody else, hey, my Credit Karma says I'm at a 700, but Jamie just told me I'm at a 650. How is there that big of a difference?
Yeah, so that's one of the biggest misconceptions. And what happens is, so a client goes on to Credit Karma, a free credit score, any of the free online stuff a consumer can get is not the same as a mortgage credit pull.
Okay.
We have 8 different algorithms that are used in the magical mortgage world to get your credit scores through.
Okay.
And a lot of times with Credit Karma, it's always going to be a little bit higher inflated. It's not based upon you borrowing any money. Even if you're talking about a credit card or a car, it's still not the same as buying a house. And people all the time think that when I pull their credit, they're like, oh, Jamie, you just brought down my score by 30 points. But you're not comparing apples to apples. I say unless it's another mortgage credit pull that you're comparing it to, we're in 2 different worlds.
Yeah.
It's a very big misconception out there, which I would be confused too. I mean, I would do this every day, but if I was just reading online, Credit Karma told me I'm an 850, I'm thinking I'm an 850.
Yeah, absolutely. I've had that happen to me when purchasing a car. Luckily, it was on the higher end. I was like, oh, really? I'm that high?
Yes.
But, I mean,
Perfect.
I have to deal with the other side of it, though, when people say it's lower. And,
Right.
and then that makes it nice that they can see that up front and that to expect that happening. So after that pre-approval process, then we're starting to look at the different types of loans. So
Sure.
conventional FHA.
Right.
What are the differences?
So we're looking at conventional financing. If you're a first-time home buyer, meaning you have not owned a property in the last 3 years, right? We're going to look at conventional financing with a 3% down payment,
Okay.
right? So you have 3% down payment, and you're going to have some mortgage insurances attached to it. And people ask, like, well, like you asked, with me earlier, like, what is the point of mortgage insurance?
Yeah.
And to put it in the easiest terms, it's making sure she has some skin in the game because you don't have 20% to put down.
Okay.
Now, on a conventional loan, the mortgage insurance that is attached will fall off the loan automatically once the loan to value reaches 78%.
Okay.
So it's not on there for life, but it is going to be on there unless you're putting down 20%. Usually with conventional financing, you're going to look at credit scores of at least a 680 or higher. Fannie and Freddie, those are the type of credit scores that they're looking for, especially during this pandemic. They kind of raise their standards a little bit.
Mm-hmm.
So when we're pulling credit, once we get those credit scores, we're already thinking like 2 scenarios, conventional or FHA. So conventional, higher credit scores, MI's on there for life. Minimum down payment is 3% for a first-time home buyer. If you are not a first-time home buyer, then 5% is the lowest you can put down. Other categories are going to be FHA. So with FHA, Federal Housing Administration, they have another great loan product. They're going to say, listen, whether you're a first-time home buyer or not, 3.5% is the minimum down payment. However, there is going to be a one-time funding fee that gets rolled into your initial loan amount, and their private mortgage insurance is going on there for the life of the loan. So FHA is like, listen, maybe you have a 620 credit score, 3.5% is going to be your down payment, but you're going to pay us a little extra every month for the life of the loan. And for people, if that's the best option for them, that is what it is.
Well, the one good thing too is, and the statistics have changed, 10 years ago, people were living in homes 15, 20 years at a time. Now, the average is anywhere between 5 to 7 years. So even if you have an FHA loan, a lot of people want to get away from that PMI. However, you are only going to be it probably for 5 to 7 years.
You're going to
maybe
get out of
10
that
years.
house before it would fall off the loan anyways.
Exactly.
So that's the only thing we talk about, like how long do you plan on being in this house? Because the other option is, all right, so you stay in this house for 5 to 10 years. You're building up equity, you're building up your credit scores, then we can look to refinance you into a conventional mortgage to get rid of the mortgage insurance.
Okay, awesome. So it still gives you options even if you have to get an FHA.
100%.
And both of them are great loans. It just
Yeah.
depends on what you're looking for.
Correct.
And how much money you have to put down. So that's awesome information there. Now, the next thing that can make a difference is an HOA. A lot of times, especially in the beach area and with how much Jacksonville is growing, you see a lot more HOAs now with all these new communities. So how can that affect your purchasing?
Well, what it can do is it can bring down your purchasing power. So a lot of times I'll have a borrower that, let's say, like, listen, right now you can be approved up to $200,000, no problems. They find a condo that they're highly interested in. Purchase price is $200, but then we found the HOA dues are $300 a month. So we have to include that, in our debt to income ratios and that monthly housing payment, and it can bring down the purchasing power. So a lot of times clients sometimes get very frustrated with that, where they thought, hey, I should be good up to 200, but then once adding the HOA dues, it brings it down. So that's why, again, as soon as you find a property, I always say, like, give me the address, are there any HOA dues? Give me the information up front, which you do a great job at doing.
Thank you.
To help me kind of structure that loan to see if it is still possible.
Yeah. And that's the one thing that I really have been digging on lately, because sometimes it's not that easy to find. So,
Sure.
you help with that a lot too, so I appreciate it. Now, as far as your mortgage amount, when we're looking at the down payment side of everything here.
Sure.
So we have the down payments, we have closing costs. A lot of people think that this is all one payment, and it is technically,
Sure.
but it's separated in different sections. So
Right.
can you kind of describe how that's sectioned out and what that money is
Yeah,
going towards?
so I'd say, we have one big pie. One big thing you have to bring to the closing table, right? So you have your down payment, let's say it's 3%, and then on average, closing costs are around an additional 3%.
Okay.
So, and with FHA, the 3.5% down payment, then I say you're gonna have to think about bringing 6.5% total out-of-pocket cost to buy this house. And closing costs can be broken up into, we have some lender fees. That's basically just the price for us to do the loan for you.
Okay.
You have your title fees because we have to make sure that there's no liens or anything crazy happening on the property. So you have your title insurance, different fees there.
Okay.
Then you have your prepaids, right? So prepaids are made up of like odd days interest, 12 months for homeowners insurance that's collected up front,
Yeah.
and then your initial deposit into your escrow account. The escrow account is made up, to pay your taxes and insurance when they're due each year. So we're gonna collect a certain amount up front to make sure there's a cushion in there.
Okay.
So 12 months down the road when we have to pay your insurance company and pay the taxes on November 1st, that we're not gonna be short in your escrow account.
Okay. And taxes are coming up with homestead, so homestead exemption is a really big way to make sure that your taxes don't go up astronomically high.
Sure.
I think they just changed the cap to 10% here in Florida. So with homestead, it can only go a max of 3%. And
Right.
that's something that we both walk you guys through to make sure that it is homesteaded. So
Right, it's one of the biggest things and the title agents are really good at going over it also at closing.
Yeah, they
It's
do.
really easy to do online. You can get it done in 5 minutes. But I make sure the borrowers make sure you get your homestead exemption in as soon as you get your deed and stuff in the mail, get that knocked out immediately. And another thing to look at is when buyers looking at some older homes, right?
Mhm.
Maybe that current owner's been in there for 20 years.
Mhm.
So right now the current assessed value by the county on that house is tremendously low. So they get really accept that low payment. We all do, but they gotta be aware, you gotta tell them listen, the county's gonna reassess the value of this property. Your taxes are gonna go up to X amount. You need to be prepared for your payment to increase in a year. And hopefully they're saving for that. They're being proactive on their own end so they don't get blindsided when you get that letter in the mail saying hey, your payment is now increased to this and you owe a lump sum right now because your escrow account is short.
yeah, and homestead exemption definitely will help with that too.
Absolutely.
With the amounts that you can get taken off. That's awesome information. So as far as your closing costs, like we talked about, your prepaids and then your down payment,
Right.
and how that can change throughout time, and making sure homestead exemption is in there.
You talked about insurance, right?
Yeah, the insurance premiums.
Yeah, so your payment is never just set in stone.
Yeah.
You gotta I tell all buyers I wish it was, but it's probably gonna creep up a little bit. Taxes going up that 3% possibly each year, but also your insurance company can change.
Yeah.
They can come back out, they can want to increase in your policy, and you're gonna have to be prepared for that. So, like you were saying, rent sometimes goes up, as will your housing payment. It's just
Yeah.
part of the process.
Rents usually, I used to be in the rental industry before I became a sales associate, and I usually say 3% inflation every year.
Right.
We'll renew your lease, but it is going to increase. We can't
Sure.
keep it there. So it's the same thing when owning a home, and a lot of first-time homeowners don't understand that, hey, just because you have a mortgage and you're not giving it to somebody else for rent, it is still going to increase. So
Right.
that's awesome information there as well. And the big thing that I want people to be prepared of is when you're dealing with money, nobody ever wants to be blindsided, like you've
Sure.
mentioned multiple times before. So Jamie, again, does a really good job on setting those expectations, and we try to with the 904 Home Guide team as well. Any other information, Jamie, that you think is really valuable?
No, I really think just the most important is again, let's build that solid foundation.
Yes.
Talk to a loan officer, have some of your documents ready, your pay stubs, bank statements, tax returns, so we can get that 360-degree view of who you are as a buyer to make sure that the process will be smooth.
Absolutely. Well, I appreciate your time with
Of
us
course.
today.
My pleasure.
And if you guys have any information that you have questions on, please reach out to Jamie. I will link his information here below. And you can also reach out to me, and we'll get you in touch with finding your dream home. Thank you, everybody, and we'll talk soon.
Look forward to helping you.
Thanks.